You probably remember the headlines about bank failures, inflation, interest rates. But almost nobody noticed the quiet announcement on March 15, 2023, the one that signaled the beginning of the end for the most powerful financial system on Earth. On that day, Saudi Arabia, the world's largest oil exporter and the backbone of the petrodollar system, agreed to sell oil to China, not in US dollars, but in Chinese yuan. For the first time in nearly half a century, the most strategic commodity in the world was officially priced in something other than dollars. The petrodollar monopoly that had propped up American power since 1974 was cracked open. Most people saw just another trade deal. It wasn't. It was a symptom of something much bigger. A late-stage breakdown in a cycle that has taken down every global reserve currency for the last 500 years. The Portuguese real, the Dutch guilder, the British pound. Each one followed a recognizable pattern from dominance, to overreach, to competition, to weaponization, to collapse. And right now the US dollar is walking that same path, step by step. Here's what almost no one understands. Being the world's reserve currency is not a permanent title. It's a phase. It comes with enormous privileges and equally enormous traps. It usually lasts somewhere between 80 and 110 years. A nation rises, builds the strongest economy and military. Its currency becomes the foundation of global trade. It overuses that power. Alternatives emerge, confidence fractures, and then, suddenly to the public, slowly to historians, the system flips. We've already seen this movie 3 times. When the Portuguese Empire lost control of the spice routes, when the Dutch lost financial dominance to London, and when Britain watched the pound fade after 2 world wars. Each time, the people living through it thought, this can't happen to us. We're different. Our system is too advanced, too central, too big to fail. They were wrong every time. Today, the dollar is deep into that same script. Oil is starting to be sold in other currencies. BRICS nations are building their own financial plumbing. Central banks are quietly trading paper claims for physical gold. And the math says we're somewhere around stage 6 of an 8-stage cycle. The phase where alternatives gather real momentum and the decline of the incumbent speeds up, sometimes exponentially. Before we walk through those 8 stages, you need to know what reserve currency actually means and why losing that status doesn't just move some numbers on a screen. It rewrites the living standards of an entire country. A reserve currency is the money that central banks and governments hold as their main financial backbone. It's the currency they use to settle trade, pay international debts, and stabilize their own domestic currencies. When your currency is the one everybody else uses as their savings and settlement layer, you gain 4 massive advantages. First, you get built-in demand. If almost every country needs dollars to buy energy, food, technology, and to service their debts, they are forced to accumulate dollars. It doesn't matter if your politics are a mess or your manufacturing base is hollowed out. The world still has to hold your money to function. That is permanent structural demand. Second, you get seigniorage. You can print your own currency at almost 0 cost and swap it for real goods and real labor from the rest of the world. You create digital entries in a ledger. In exchange, other countries send you oil, cars, chips, steel, and food. You consume above what you produce because everyone else is willing or forced to hold your paper. Third, you get cheap credit. Because the world wants your currency, it also wants your government bonds. That demand pushes interest rates down. You can borrow far more, for far longer, at far lower cost than your economic fundamentals would normally allow. Deficits that would crush other nations become business as usual for you. Fourth, you can export inflation. When you print too many units of your currency, the dilution is spread across all the countries that hold it. Their central banks absorb your excess. Their citizens feel part of the price shock. Your domestic system still suffers, but nowhere near as badly as it should. You've turned your inflation into a global problem. Put those 4 together, and you get the ultimate financial superweapon: reserve currency status. It lets you run deficits for decades, maintain a military footprint in hundreds of bases, and keep your citizens living better than your real productivity deserves. But once you understand the upside, you also see the nightmare on the other side. Because when the world no longer needs your currency, all of those advantages reverse. When countries no longer have to hold your money, demand evaporates. Your government can't borrow cheaply anymore. Printing money turns instantly into domestic inflation because there's no one left to absorb the excess. Your standard of living falls back toward what your real economy can actually support. This is exactly what happened to Portugal, then the Netherlands, then Britain. And the early stages of that same adjustment are already visible for the United States. Now let's walk through the 8-stage pattern that keeps repeating and locate exactly where the dollar sits inside it. Stage 1 is the rise to dominance. A currency doesn't become global money by accident. It gets there because the country behind it is the undisputed leader in both economic output and military projection. Trade routes, technology, finance, and force all converge in one place. That concentration of power creates trust, or at least the perception of safety. If you're a merchant, a banker, or a government in that era, you assume money from that empire will hold value and be widely accepted. In the 1500s, Portugal was that empire. Its ships controlled the sea lanes around Africa to India and the East Indies. Spices like pepper and cinnamon traded at prices higher than gold. Portuguese forts guarded choke points from East Africa to Southeast Asia. If you wanted to participate in that trade, you needed Portuguese coinage. The real became the de facto currency of Asian commerce, not because Portugal was nice, but because its cannons and caravels enforced that reality. A century later, the Dutch took the crown. The tiny Dutch Republic built the most efficient trading and financial machine Europe had ever seen. Amsterdam became the neural center of global commerce. The Dutch East India Company grew into a corporation so large that, adjusted for today, its value dwarfed modern tech giants. Dutch ships dominated shipping lanes. More importantly, Dutch finance set new standards. The world's first stock exchange, a highly trusted central bank, sophisticated credit instruments. The guilder became the safest, most liquid currency on earth. By the 19th century, Britain had replaced them both. After defeating Napoleon, the British Empire controlled roughly a quarter of the planet's land and people. The Royal Navy ruled the oceans, British factories powered the Industrial Revolution. London's city became the brainstem of global finance, with the gold standard formally linking the pound to a fixed quantity of gold. Sterling notes were literally as good as gold. By 1900, the majority of world trade was invoiced in pounds. Then came the United States. After World War II, Europe lay in ruins. American factories were intact. The U.S. held the majority of the world's gold. The Bretton Woods Agreement locked in a new architecture. Other currencies pegged to the dollar, and the dollar pegged to gold at $35 an ounce. For the rest of the world, that meant holding dollars was effectively the same as holding gold, but with better liquidity. Even when the gold window was slammed shut in 1971, the U.S. managed to keep dollar dominance alive by striking a different deal, the petrodollar agreement with Saudi Arabia in 1974, which tied global oil trade to the dollar. That's stage one. Dominance through real power. But inside that dominance is a fatal temptation, the urge to stretch just a bit further. At the height of that power, something predictable always happens. Once a country gets used to being the center of the financial universe, discipline erodes. Wars feel affordable. Social programs feel permanent. Political promises are made under the assumption that the rest of the world will quietly fund them. The currency still looks strong on the surface, but underneath, debt and commitments start to pile up. That's the second phase of the cycle. Peak power, sliding into overreach. Portugal tried to garrison a string of forts from Africa to Asia with a tiny home population. It fought rival Europeans, suppressed local uprisings, and borrowed heavily to keep the illusion of control. The coin stayed widely used for a while, not because Portugal was still healthy, but because everyone was already used to settling trade in its money. The Dutch repeated the pattern. They built an empire of ports and shipping lanes, then found themselves locked into expensive naval conflicts with England and continental wars involving France. Trade revenue had to support not just commerce, but fleets and fortresses. Debt service costs crept up. Yet merchants still trusted the guilder. Amsterdam's financial system was so advanced that people ignored the underlying strain. Britain did exactly the same. At its zenith, it maintained a navy big enough to outgun any two rivals. It fought colonial wars from South Africa to Asia. It financed global railways and colonial administrations. The pound still looked unshakable, but by the early 20th century, Britain was borrowing from the rising power across the Atlantic just to fund its wars. The United States is no exception. After 1945, it faced no peer competitor. That advantage tempted Washington into an almost permanent war footing. Korea, Vietnam, the Cold War arms race, then the Gulf War, Iraq, Afghanistan, the war on terror, and a network of hundreds of overseas bases. At home, tax cuts, social programs, and bailouts were layered on top of each other, always financed by the same machine, issuing new debt that the world was eager to hold. By the time the global financial crisis hit in 2008, U.S. federal debt had already ballooned into the trillions. After the pandemic money printing, it rocketed into the tens of trillions. Yet the dollar still looked unchallenged, because up to that point, there was no ready-made alternative big enough to replace it. Which brings us to the third phase, the rise of competitors. Rival powers never sit still. When they see the incumbent empire abusing its financial privilege, they quietly start building Plan B. Not to overthrow the system tomorrow morning, but to make sure they don't go down with it later. Other European states did this to Portugal by launching their own chartered companies and seizing their own slices of the spice trade. Better ships, better weapons, better financing, and, slowly, the Portuguese monopoly eroded. Traders now had a choice. The same story played out between Amsterdam and London. As Britain industrialized and its navy expanded, it didn't just copy Dutch finance, it upgraded it. London offered bigger markets, more credit, deeper insurance. For a while, both cities mattered. Then one started to matter more. In the 20th century, New York did the same to London. Once the U.S. economy overtook Britain's and the Federal Reserve System matured, global capital slowly began to prefer dollar assets. Even while the pound was still officially the world's linchpin, the financial gravity was already shifting across the Atlantic. Today, you can see that same dynamic playing out again, but with a twist. Instead of one challenger, the dollar faces an ecosystem of alternatives. China has built its own cross-border payment rails. Russia has done the same. BRICS nations talk openly about settlement mechanisms that bypass Western-controlled systems. Bilateral trade deals in local currencies are multiplying, not because those currencies are perfect, but because the countries involved don't want to be trapped inside a single, politicized system. At this stage, the dominant power still thinks it's in control. It sees these alternatives as minor, experimental, not serious. But the rest of the world isn't building them for fun. They're building them because of what comes next. Phase 4 is where the incumbent starts using its currency, not just as a tool, but as a weapon. When a reserve-issuing country feels its authority challenged, it reaches for the most powerful lever it has: access to its currency and its financial infrastructure. It starts freezing assets, cutting institutions off from the global messaging network, threatening sanctions on anyone who dares to trade with the wrong partner. On paper, it looks like a brilliant tactic. In practice, it's a signal flare to every government on earth that says, your savings are only safe as long as you obey our politics. Portugal used trade bans and port closures against its rivals. That pressure didn't restore Portuguese dominance. It simply pushed the Dutch and English to accelerate their own networks. Britain used its control of the seas and financial hubs to punish enemies during war. The message was clear. If your money is in our system, we can grab it. In the short run, that hurt their enemies. In the long run, it convinced neutral players to move their wealth elsewhere. The United States has brought this to a new level. Sanctions used to be targeted and rare. Over the last decade, they've become structural. Whole banking systems have been cut off from dollar clearing. Hundreds of billions in foreign reserves have been frozen with a signature. Access to SWIFT, the messaging backbone of global finance, has been turned on and off like a switch. If you're a policymaker in a non-Western capital watching that happen, what conclusion do you draw? That the dollar is safe, or that you need an exit route before you're the next target? This is why, after the freezing of major central bank reserves and the weaponization of SWIFT, you suddenly see a surge in non-dollar trade, a sharp increase in gold purchases by central banks, and a proliferation of alternative systems. It's not ideology, it's self-defense. That's what moves the system into the fifth phase: visible cracks in confidence. At first, the changes are small. The percentage of global reserves held in the dominant currency ticks down a few points. A little more trade happens in other units. Headlines barely mention it. But beneath the surface, central bankers are quietly recalculating the risks of holding too many eggs in one basket. For previous reserve currencies, this adjustment took decades because moving gold across oceans and restructuring trade networks was painfully slow. Today, those same shifts can happen at digital speed. Selling one type of government bond and buying another is a few keystrokes. Swapping a portion of your reserves into gold or into another currency takes days, not years. So you see a slow, then faster, decline in the dominant currency's share of world reserves. You see central banks setting record purchases of bullion. You see big resource exporters experimenting with non-dollar invoicing. None of these events alone kill a reserve currency. But together, they mark a structural change. The era of unchallenged dominance is over, which brings us to the phase we're living through right now. The moment when alternatives reach critical mass and the network effect flips. For decades, the dollar wasn't just dominant because of history. It was dominant because everyone else used it. If your trading partners, your banks, your suppliers, and your lenders all preferred dollars, then you did too. That's the power of a network effect. The more people inside the system, the more costly it is to leave. But network effects cut both ways. Once enough big players demonstrate that they can settle oil in another currency, clear trades through a different system, or denominate contracts in a new unit, the pressure reverses. Now, staying 100 inside the old system looks risky. Now diversification feels safer than concentration. That's what Saudi Arabia's yuan for oil deal really signaled. Not that the dollar disappears tomorrow, but that even the core pillars of the petrodollar architecture are quietly hedging. The countries who built their entire model around dollar oil now feel comfortable testing a different road. At a certain threshold, that behavior becomes self-reinforcing. The more trade is done in alternatives, the more liquidity those alternatives have. The deeper those markets become, the easier it is for the next country to join. The dominant currency doesn't vanish. It just loses its gravitational pull. And once that tipping point is passed, the last two phases of the cycle move from theoretical to just a matter of time. When a network flips, the shift feels slow until it suddenly isn't. Every reserve currency collapse in history has followed this same rhythm. Decades of stability, years of pressure, months of acceleration. That acceleration is the seventh stage, the crisis phase, and it always begins with a shock that exposes how fragile the old system truly is. For Portugal, the trigger was a war it couldn't win. For the Dutch, it was Napoleon's blockade that cut their trade arteries in a matter of months. For Britain, it was the crushing debt of World War II and the financial humiliation of the Suez Crisis. For the United States, the trigger hasn't hit yet, but the setup is already visible in plain sight. The world is overloaded with dollar obligations. More than $80 trillion in dollar-denominated liabilities sit around the world. Corporate loans, sovereign debts, trade contracts, derivatives. For decades, this structure functioned smoothly because everyone trusted the same thing. The Federal Reserve would always step in, always stabilize markets, always ensure the dollar remained the safest place to run. But that faith has a breaking point. And once it snaps, it won't be a gentle correction. It will be a stampede. A global shock could come from several fronts. A BRICS gold-backed settlement currency. A U.S. fiscal crisis, as interest costs consume the federal budget. A banking collapse triggered by commercial real estate defaults. A geopolitical miscalculation that drags the U.S. into simultaneous conflicts it cannot decisively control. In normal times, any one of these would be manageable, but late in a reserve currency cycle, they compound. When the shock arrives, the world won't move gradually. Central banks will move in blocks. Oil exporters will shift invoicing overnight. Sovereign wealth funds will rebalance reserves with a few digital transactions. When the selling begins, it won't feel like a market correction. It'll feel like an avalanche. This is the essence of Stage 7. Panic diversification. The dominant currency doesn't collapse because people hate it. It collapses because the incentives flip. When holding the old currency carries more risk than switching to alternatives, the migration becomes self-fulfilling. Each sale triggers the next sale. Each country that diversifies gives another country political cover to do the same. Liquidity thins, volatility spikes, confidence unwinds. In this phase, even the dominant power becomes trapped. If it raises interest rates to defend the currency, its financial system breaks. If it prints money to buy its own bonds, inflation rips through the domestic economy. In every historical case, the outcome was the same. The reserve currency lost 30–60% of its real purchasing power within a single decade, which leads to the eighth and final stage, replacement. People imagine that when a reserve currency falls, a new one instantly takes its place. That's not how history works. After the Portuguese real collapse, the Dutch guilder didn't dominate overnight. It took decades of growing trust and liquidity. After the Dutch system fell, the British pound ascended gradually through financial depth and global trade. After the pound lost supremacy, the dollar took nearly 15 years to become the uncontested anchor after World War II. Transitions are never clean. They're negotiated, chaotic, overlapping. And this time, the world doesn't seem to want a single hegemon. The emerging structure looks multipolar: a yuan-centric Asian bloc, a euro-centric European bloc, a BRICS commodities-backed settlement mechanism, and the US dollar retaining influence, but no longer absolute command. What takes over depends on something deeper than size. Trust. Which currency offers stability? Which system has the least political weaponization? Which network can clear global trade without forcing countries to pick sides? That's what will determine the next reserve structure. Not ideology, but credibility. And this transition will move faster than any before it, because unlike the pound or the guilder or the real, the dollar sits in a world of instant capital mobility. You don't need ships to move gold. You don't need couriers to transfer reserves. You don't need years to renegotiate terms. A central bank can exit billions in treasury holdings in minutes. Meanwhile, digital infrastructure already exists for alternatives. SIPs, SPFS, bilateral swap lines, commodity-linked settlement, regional payment blocks. 90% of the plumbing is already built. All that's missing is the moment that forces global adoption. But this documentary isn't just about nation-states, it's about you. Because retail investors experience these transitions very differently from governments. During the fall of previous reserve currencies, one asset outperformed everything else: gold. When Britain devalued after World War II, gold soared. When the dollar was severed from gold in 1971, gold surged 20x in less than a decade. When confidence breaks, people flee to what cannot be printed. The same is happening quietly right now. Central banks are buying gold at the fastest pace since the 1970s. Not because they love shiny metal, but because it's the only reserve asset that cannot be frozen, cannot be sanctioned, cannot be devalued by someone else's policy mistake. Resource nations also thrive during transitions. Countries controlling energy, food, metals, and critical minerals gain leverage. Those at the center of new trade routes, the Middle East, Central Asia, Southeast Asia, reposition themselves as indispensable nodes in the emerging system. The biggest losers: dollar-only savers, foreign buyers of long-term U.S. debt, countries trapped in dollar-denominated loans, and the American consumer, whose standard of living has been artificially boosted for 5 decades by the dollar's exorbitant privilege. When that privilege ends, imports become expensive. Military reach becomes limited, deficits become dangerous, and for the first time in living memory, the United States will have to live within the limits of its real productive economy, not its printing capacity. That's what this entire story leads to. Pattern recognition. Every chart, every historical example, every geopolitical misstep points to the same conclusion. The dollar isn't collapsing tomorrow, but its dominance is ending, gradually at first, then suddenly, not because America is weak, but because the global system around it has changed, and because the cycle that lifted the dollar is the same cycle that now pulls it down. So here's the final question, the one history asks every generation. Do you see the pattern early, or do you see it when it's too late? Because, right now, the signals aren't subtle. BRICS expansion, record central bank gold buying, surging non-dollar trade settlement, the petrodollar fracture, the weaponization risk, the debt curve bending upward at the speed of compounding mathematics. The timeline is 10 to 15 years, maybe faster, maybe slower, but directionally locked. If you understand that, then you understand why this channel exists. Global Rewind tracks every milestone of this transition, every policy shift, every trade realignment, every crisis catalyst. The decline of a reserve currency reshapes wealth, power, and history. It happened 3 times before. It's happening again, and if you can see the pattern now, you're already ahead of 99% of the world.